こんにちは、ピクテの萩野です。本日はですね、ピクテインベストメントオフィスのですね、シモンさんをお招きして、ちょっと会話をさせていただけたらと思います。ピクテインベストメントオフィスは、ピクテのお客さんの中でも特にウルトラハイネットワースの方々の運用を行っておりまして、基本ですね、日本円でいくと150億円以上、かつですね、10年以上の投資ができる方のですね、運用を行っている部隊でございまして、全体の資産運用額は4兆円以上の運用を行っている方です。で、シモンさんはですね、1980年代から投資活動を行っていまして、このチームはですね、30年以上プライベートエクイティの運用をマルチアセット、バランス運用の中でしっかり運用してきた実績で、過去いろいろなマーケットのですね、ショックも経験しながら運用していて、日本ではですね、どちらかというと、本当にもう伝説、うちのピクトの中ではもう本当伝説のですね、ファンドマネージャーの一人でございます。Thank you very much for today to give us the time. And then I already introduced us everyone that's your team, structure, team that's the characteristic. And then all of the PAMJ people respect you. Today's I like to ask you that's your investment philosophy and also your experience in the past, and that if I could hear from you, that would be great. So first of all, would you give us your team investment philosophy?
Yeah, sure. It's a great pleasure to be with you today. So the investment philosophy our team is, which is basically an investment boutique located within the Pictet group. What we are doing for our clients is basically what we call long-term investment strategies. And our philosophy is based on the idea that if you invest in companies that create what we call economic value creation, i.e. cash for our shareholders and sustainable cash flows, and you stay invested for the long term, you can produce extremely high and superior performance over the long term. So what we call a compounding effect. By staying invested and keeping investment into highly rewarding cash-based investment, the end result will be extraordinary wealth creation over the very long term, 10-year plus.
So in the past, more than almost more than 10 years or 20 years, actually long time, that's your track record. You generated almost 10% annual return, right?
That's right. Our multi-asset mandate that include cash, liquidity, fixed income, public equities, and private assets, we've compounded close to 10% return, which is over the very long term, the so-called top decile performance among the US endowment funds, famous funds like Harvard, Yale, or MIT, and we are near the top of the performance there over the very long term, i.e. 5, 10, 20 years plus.
Your performance is better than Harvard University's when I look at actually.
Yes, but Harvard has not done so well recently, so it's not a fair comparison there.
Oh, I see. Okay. I think that your portfolio structure is very unique when I look at. This is not usual balanced portfolio. That gave me the big impact and also helped me to create the Polaris, what we've been learning at. But if you could introduce your portfolio structure, that would be great.
For sure. Because of our clients are very long term, we're talking 10-year plus. In fact, 10 years is not right. It's multi-generational wealth. So wealth that's going to be transmitted to the children, grandchildren of our clients. We have almost infinite period of investment in front of us. And if you look at the long-term performances of financial markets, if you take the US market over 120 years, 150 years, where we have very good data, equities always provide you the best return, followed by corporate bonds or credit, then treasuries, and then cash. Very, very long term, we're talking about 10% return in equity market, nominal, 7% real. So if you have 20, 30, 40 years in front of you, you should allocate most of your money to equity and equity-linked investment. And obviously, you should have some investment in credit and cash liquidity to help you smooth the allocation between public equities, private debt. But otherwise, most of your assets should be in equity-linked investment. And here we're talking about at PIO, something between 60 and 80% in equity-linked. And anything linked to cash liquidity, credit, or fixed income in general is usually between 20 and 40% of
40%. Wow.
So, but 80-20 is probably more what we are aiming for our clients.
So within the equity portfolio, also that is quite unique. That year, if you could introduce that year composition of that year, equity portfolio, that would be great, actually.
Sure. Well, usually we allocate at least half of the equity-linked assets into public equities, the remaining into private equity. Looking at the public equity, there we, as with all the other assets in which we invest, we are so-called cash flow-based investors. We are looking at economic value creation from companies, from a cash-based type of return. We don't look at stock prices, but only what the companies are doing in terms of generating cash and what they do with it. So capital allocation is very important. So the key for us is do fundamental research on companies. And we look at companies, even though they might be public, as if we were the owners of a private companies. We just ignore the stock market, just looking what the company is doing with our investment, what type of return they are achieving on the invested capital, and how they reinvest the surplus capital. So surplus capital can be reinvested in a company if the opportunities are there. Otherwise, the surplus capital should be redistributed to shareholders through dividend or share buyback. So we have two very strong criteria that we look at. What are the opportunities for the companies to generate cash on their current business, and how they allocate the capital allocation. That's the two key things. And we believe that if we have done our job, fundamental research of the companies, the suppliers, the competitors, and we understand the business model of these companies, and we are satisfied that they can produce sustainable free cash flow for the benefit of shareholders, we believe that once you've done that job, there's no need to diversify your portfolio. So in our strategy, which we call core equities, we own no more than 20 companies on a worldwide basis.
Do you look at the valuation as well?
So the valuation is very important when you do your first purchase. Obviously, high quality companies that generate high return, they are usually expensive. So you need to make sure that when you come in, you buy at what we call a fair price. They don't need to be cheap. Fair price is enough for high quality companies. And obviously that's the only time when you look at valuation. Like any investors, you want to know how much you're paying for the assets you're buying. And then you just look purely from an accounting or financial viewpoint what the companies are doing with your investment. And the only other time when you're going to look at valuation is if you need to exit, either because the valuation has become completely crazy or because the company's fundamental over the medium term are deteriorating and the potential for growth is not there anymore. So basically you learn it twice. When you buy your stock, when you sell it. Otherwise, in the meantime, you just don't look at it.
I see. I think your team is very rare in the world. I think in Japan, I don't think that's the same as the teams exist in Japan. Since you've been investing in this private equity, private assets more than 30 years, by last year, multi-asset allocation portfolio. So you got a lot of experience. But when you invest in those private equities, do you look at also individual company, or what do you look at the private equities once you invest in?
So in private equity, obviously, you don't invest usually directly into companies. You invest through a general partners fund. And here, even though we delegate the responsibility of choosing the underlying portfolio companies, we make sure that the partners we choose follow the same investment philosophy as ourselves. So when we select a private equity fund, we want to make sure that the return they have in the past produce and what we expect from them in the future is that they concentrate on the value creation process, i.e. that the return they can produce, where we expect a 20% gross return, 15% net, or about 2 times multiple of investment over 5 years, that the most of the return will come from the value creation economic-wise and not from financial engineering, put it a lot of debt on the companies, or multiple arbitrage buying companies at, let's say, 10 times EBITDA and selling it at 12. That's fine if they do it, but we want the main source of return coming from this economic value creation process there. This is very important because when things go wrong, like we have COVID, a crisis, a war starting somewhere, it might be difficult to sell the companies. But if the company is healthy and produce return, you don't mind staying invested because they still create value for you. But on the other hand, if you invest with funds that generate most of the return from financial engineering, like debt, and like we've seen in the past 2 years, short-term rates moving from 0 to 5.5%, then your investment is in danger. So that's the important criteria we look at when we invest with GP. It's general partners of a fund there. That's key. So we make sure that when we invest ourselves or through intermediaries like fund, we follow exactly the same investment philosophy.
I see.
And there's a lot of coherence in the way we invest.
Private assets include private equities, real estate, private debt, whatever.
Yes.
Also, in terms of valuation, is there a cycle? Or, the high valuation, the cheap valuation, is there a cycle in the past? How?
There are some valuation cycle, but obviously a lot of it is determined by the cost of debt. As you know, most of the private equity investment are so-called leverage buyout, i.e. you put some debt on the investment there. So if your cost of debt is very high, you would have yourself, if you are targeting a 20% return and a multiple on investment at 2 times, you would have to pay for a lower value for the equity.
Right.
It's the mathematical of it. So, and if interest rate goes down, you can put a bit more debt and you can pay a bit more for the equity itself.
Right.
So you have this arbitrage with the interest rates. So, but overall, the valuation of companies remain relatively stable over time, and the interest rate and the level of debt will change the math. But ourselves, we are, we don't make forecasts about the market, about interest rate, etc. We target investment return. So private equity, we are targeting 15% net. So whenever we make an investment,
15% net.
Net.
I see.
In US dollar terms.
Right.
So we are not saying, well, currently expected return are about 10%. This is attractive. We're only going to make investment which, from the outset, will give us this like 20% gross, 15% net. Like public market, we are targeting 10%. The S&P might be high or low, but all the new investment we make, we are targeting 10%.
Okay.
Irrespective of the market environment.
Nice, I see. Okay. Finally, and recently there's the real estate market, the Star Woods in the US. The news came out that they start, Star Woods start facing with, shortage in cash.
Yes.
Yeah. But how do you think how do you think there's this situation in the real estate market right now from your experience in the past?
Well, in the US, currently the stress in the market is mostly with commercial real estate.
Yes, I see.
And some of the shopping malls. Commercial real estate has been hit on a worldwide basis because following the coronavirus crisis, people have been working more from home. So companies have needed less space in the major cities. So that's the environment now. There's probably been too much debt because interest rate very, very low, too much leverage in investment in real estate. So there will be, there's a type of crisis developing, but for the time being is purely localized. And that would be providing, at least for us, some investment opportunities because we liked through mostly a hedge fund strategy to invest through people managing distressed debt. And you need specialized knowledge to do that. So we have partners that can manage this type of situation. So we're looking forward to some nice opportunities for people who have cash. Ourselves, in our strategic asset allocation, we only put real estate on a opportunistic basis. We don't invest systematically, whatever the environment in real estate. Because one of the problems in real estate, as I was saying with private equity, the real estate market, the yields are relatively low. So you always need leverage to make it attractive.
Like now.
Like right now, well, you need, if you pay 100% cash for your real estate, the return are very high. Always, loan to valuation 50% at least. So we find ourselves this type of strategies way too dangerous because the source of return is the leverage. It's not the value creation. Some people ask, when we do investment in real estate, there would be two reasons. One, because it's distrust. So we were very big investors in the real estate crisis in Europe in the beginning of the 2010s. But we have not put more money into that since then. And also in the US and through some specialist private asset firm, we allocated money to real estate. But now we've not committed anymore. Because that was distressed. Traditionally, as we say, we want this investment to produce return on what we call value add, value adding to the investment. So we could do real estate if the project is for someone to transform the assets, going from commercial real estate maybe to apartments, flats, type of thing, or changing value add type of investment. So we really need to see that, because if you only count on the leverage, that's very unhealthy. We've seen that exactly in US when you start from interest rate close to zero and move to 5, and you're in trouble. If value add, at least your return will come from adding value to the assets, asset transformation. So we don't really allocate to real estate on the structural basis, strategic basis, only from an opportunistic basis. Because it's always the same philosophy. We want cash-based type of return, not financial engineering.
Okay, thank you very much. But anyway, the market is not the easy market, I feel. But actually, if you could, give us a message to Japanese investors, in 2 or 3 years' times, we have to be cautious, we have to be bullish, whatever. Well, anyway, I don't think that's we should say, we should expect from your investment philosophy. But in terms of investment stance, or in terms of this year, how can I say, 10 years investment, whatever, if you could give us Japanese investors, that would be great, actually.
Sure. Well, ourselves, we tend not to make any market forecast or macroeconomic forecast, because basically history has told us over the last 40 years, personally in our team, and obviously academic literature as well, that these forecasts are usually not very useful in terms of the investment there. So what we do basically is ourselves is quality investing. So when markets currently are quite high, there's no doubt about it. Most of the equity market around the world have hit all-time highs, and despite the fact that rates, like in US, 10-year treasuries have moved up from 1.5% to above 5%, and it's been coming down a bit recently, or short-term rates up also to 5.5%, and equity markets are all-time high, so there's a bit of a discrepancy here. So in that environment, it's difficult to find new investment which are very attractive that would provide for us, like in the public market, a 10% annualized return over the next 10-year plus. But ourselves, we are confident we can keep delivering on our returns for our investors, because we have this, what I call cash flow-based investment strategy, which sometimes we call quality, very sound balance sheet, resilient cash flow, sustainable growth paths in front of us. And if you can keep that in mind in how you invest, over the medium term, the companies will keep delivering the cash flow that you need. And the prices will move up and down, as we always been the case. Every 3-4 years, you get 20-25% correction. Even every 10-15 years, we have 50% correction in the market. But usually, that provides extremely attractive investment opportunities. And the people who can stay invested, we can reinvest all the cash flow at very attractive prices. And then 10 years later, 20 years later, if you look back, you're going to say, how wonderful this investment period has been. But throughout the period, yeah, sure, we will have worries in our head continuously, because the media is always talking about what goes badly. They never talk about what goes extremely well. And over the medium term, longer term, all this short-term fluctuation, volatility, in fact, just provides you with opportunities, not risk. So if you stay invested for the medium to longer term, 10, 20, 30, 40 years, you will have wonderful returns.
最後にピクテは200年以上、1805年以来200年以上ですね、個人の投資家のお金をもう本当に運用してきた会社なんですけども、私自身25年、ほぼ25年この会社で勤めていて、本当に10年単位で投資をすることがどれだけリターンを上げることができるかということを学んだんですね。ですから皆様にもぜひメッセージとしてお伝えしたいのは、10年単位で物事を考えてリラックスして投資を行うということをですね、今日のメッセージ、シモンさんからの方のメッセージで、私今日終わりたいと思います。シモンさん、today, thank you very much.
You're welcome. It was a pleasure to meet you today and your investors and Japanese people.
ありがとう。